Inflation was almost dead. The war just brought it back. For 5 straight years, the Federal Reserve fought the worst inflation since the 1970s. They raised rates 11 times. They held them at painful highs for over a year. By February 2026, they were finally close. CPI sitting at 2.4%, almost at the 2% target. Almost over. Then Operation Epic Fury began, and in 72 hours, everything changed. Brent crude crossed $82 a barrel Tuesday. European natural gas has surged 65% in 5 days. The producer price index, the price businesses pay before they pass costs to you, just spiked 0.8% in a single month. Goldman Sachs is now warning CPI could climb from 2.4% back up to 3% by the end of 2026. And the Federal Reserve is sitting in a chair nobody wants to sit in right now. I've lived through 4 oil shocks in my lifetime. The 1973 Arab embargo, the 1979 Iranian Revolution, the 1990 Gulf War, the 2022 Russia-Ukraine energy crisis. Every single one of them followed the same sequence. Oil moves first, inflation follows, markets reprice, and the investors who understood the sequence early walked out stronger. The ones who didn't paid for the confusion. I'm walking you through 4 things that every investor needs to understand about this war and your money. And in the final section, 3 specific things you can do starting today, not someday today, to protect what you've built. Stay until the end. The third action step is the one almost nobody is taking right now, and it's the one that matters most. Let's start with the number that changes everything else, and most people are reading it wrong. Oil at $82 a barrel sounds like a commodity story, a number for traders on Bloomberg terminals. It isn't. It's a tax on every person who drives, eats food that was transported, heats a home, or buys anything that was manufactured and shipped. Oil touching $82 doesn't stay in the energy sector. It bleeds into every corner of an economy within weeks. Here's the formula that explains exactly how much. Economists at Mizuho calculated that a permanent $10 per barrel increase in oil translates to roughly 0.2 percentage points of additional U.S. inflation per year. It also shaves around 0.1 percentage points off economic growth. That relationship is reliable. It's been tested across 5 decades and multiple oil shocks. Brent crude was sitting at approximately $60 per barrel before Trump's Venezuela operation back in January. It is now above $82. That is a $22 increase in roughly 9 weeks. Apply the Mizuho formula. You're looking at roughly 0.44 percentage points of additional inflation pressure before secondary effects even kick in. And secondary effects are where ordinary people feel it hardest. More than 9% of the entire U.S. consumer price index is made up of energy and motor fuel. Analysts at Rabobank noted this week that oil at current levels is more inflationary than when Russia invaded Ukraine in 2022. That's not a casual comparison. The 2022 energy shock drove U.S. inflation to 9.1%, the highest in 40 years. We're nowhere near that yet, but the direction is now unmistakable, and Goldman Sachs has formally revised its forecast. CPI at 3% by year-end if oil price gains hold. That single revision wipes out 3 years of Federal Reserve work in one sentence. Tanker freight rates have already tripled since Operation Epic Fury began. War risk insurance premiums at Lloyd's of London jumped from 0.2% to 1% in less than a week. Every barrel that still manages to move through or around the Gulf now costs dramatically more to transport. Those costs don't evaporate. They flow directly into what you pay at the petrol pump, at the supermarket checkout, and in your energy bill this winter. This is the first domino, and it fell 5 days ago. Now let's talk about the thing that makes this crisis genuinely different from every Middle East conflict since 1990. This is the part most financial channels are glossing over, and it's the most important thing in this entire video. The Federal Reserve is trapped completely, and this specific trap has a name that most people don't know. It's called the inflation ceiling. Here's what I mean. When geopolitical crises hit, central banks usually have a clear playbook. Cut rates, ease policy, protect growth. That's what the Fed did after September 11th in 2001. That's what happened after the 2008 financial crisis. Danger appears, rates come down, economy gets support. That playbook is unavailable right now, and here's exactly why. The Federal Reserve has not hit its 2% inflation target since early 2021. 5 consecutive years of above-target inflation. Coming into this war, CPI was at 2.4% and still above target, still requiring vigilance. The Fed was already holding rates steady, pushing back on any talk of cuts. Then the war started. Oil spiked. PPI jumped 0.8% in a month. And now Federal Reserve officials are publicly saying they need to wait and watch before making any move at all. Mohamed El-Erian, chief economic advisor at Allianz and one of the most respected macroeconomic minds on the planet, wrote on Sunday that stagflation risk is now elevated specifically because the Fed has, in his words, limited policy flexibility. He called the strikes on Iran yet another shock to a global economy that has so far proven extremely resilient, and warned that an extended conflict would fuel inflation, disrupt supply chains, and undermine growth simultaneously. That's stagflation. Inflation going up, growth going down at the same time. For a central bank, it's the worst possible combination because there's no clean answer. Lower rates to protect growth, and inflation runs hotter. Raise rates to fight inflation, and you tip a slowing economy into recession. Ed Yardeni of Yardeni Research told CNN this week, the Fed's got to deal with the facts on the ground, and this oil shock has clearer consequences for the economy and inflation. Markets on Monday increased bets that the Fed will stay on hold at its March meeting. And now analysts at Mizuho are saying rate cuts may be eliminated entirely for 2026. And if oil reaches $100 to $130 per barrel, a rate increase becomes possible. The 10-year Treasury yield climbed to 4.117% this week. Bond investors are not running to safety. They're demanding higher yield to compensate for the inflation they can already see coming. That bond market signal is one of the most reliable early warnings in finance. It's flashing right now. Europe's position is even more precarious. Bloomberg Economics wrote that sustained higher energy prices would take Europe to the brink of recession. Natural gas prices there have surged 65% in 5 days. For the UK, the combination of energy import dependency and a weakening pound creates a double squeeze that the Bank of England has very little room to address. The inflation ceiling isn't going away quietly. It rises or it cracks. And either outcome costs ordinary investors real money. Here is what the markets are actually doing right now. And more importantly, what it tells you about who is thinking clearly and who is panicking. The S&P 500 dropped more than 1% at Monday's open before clawing back to roughly flat by the close. The AGBI analyst Mateen Khalid noted that U.S. equities are trading at a valuation multiple of 22 times earnings, and now have to absorb simultaneous pressure from AI disruption concerns, Trump's tariff uncertainty, and a full energy crisis. That's a crowded set of headwinds for a market that was already priced for perfection. But here's what the headline index number conceals. Energy stocks are up. Defense stocks surged. Lockheed Martin, Northrop Grumman, companies with direct exposure to expanded defense budgets. These moved in the opposite direction of the broader market. Cryptocurrency dropped sharply. Bitcoin fell roughly 5% as risk appetite collapsed. High beta technology stocks and speculative assets got hit hardest. These are exactly the patterns you would expect from institutional money reading the inflation ceiling story correctly. Retail investors in moments like this tend to do one of two things. They either panic sell across the board, dumping quality holdings alongside the damaged ones, or they chase the move by piling into energy and defense after those stocks have already spiked. Both are emotional responses. Both destroy capital over time. Smart institutional money is doing something that looks almost boring from the outside. They're rotating with precision into energy, into short duration bonds, into gold, into defense. They're trimming positions in airlines, long duration bonds, high multiple growth stocks. They're building cash selectively. And critically, they're watching for the signal that this this conflict has a ceiling, because the moment that ceiling becomes visible, the rotation goes back into quality equities at lower prices. In the Forex market, the story follows the same logic. The US dollar index strengthened. Dollar assets retain their safe haven premium. Even in a war America started, the Canadian dollar held firm. Canada exports energy, so the oil spike directly supports their economy. The British pound and the euro are under meaningful pressure. Both economies are energy importers sitting directly in the blast radius of a Gulf supply shock. For UK investors holding dollar-denominated assets, the weaker pound actually amplifies returns on those positions even before prices move further. I watched a similar rotation play out in August 2022 during the height of Europe's energy crisis. The investors who understood what rising energy costs meant for different sectors and acted on that understanding in the first 2 weeks, protected far more of their wealth than the ones who waited for clarity. Clarity in a crisis always arrives after the opportunity has already passed. You stop being someone who waits for the market to tell you what to do. You become someone who tells the market what you already know. 3 actions, specific, starting today. No vague advice. The first action, if your portfolio has no energy exposure whatsoever, that is a structural gap right now, not a neutral position. A 5 to 10% allocation to an energy sector ETF inside a Roth IRA or a 401k for U.S. investors, or a stocks and shares ISA for UK investors, puts part of your portfolio on the correct side of this oil shock. When energy companies' revenues rise with oil prices, you own a piece of that revenue increase. The higher petrol prices you're paying at the pump get partially offset by the performance of what you own. That's not speculation. That's structural balance. It takes less than 10 minutes to set up through any major brokerage starting today. The second action, check your cash. Right now, as the inflation ceiling rises, cash sitting in a standard current or checking account earning near zero is not a safe position. It's a silent loss. For U.S. investors, a 3-month Treasury bill through Treasury Direct currently yields above 4% with full government backing. You earn real return while keeping capital accessible. For UK investors, a competitive cash ISA preserves your tax-free allowance while your money actually keeps pace. This isn't exciting advice. It's the kind of quiet, unsexy decision that preserves thousands of pounds and dollars that inflation would otherwise eat without making a sound. The third action, and this is the one almost nobody is doing right now, write down your conviction watch list this week while fear is still high and prices are still moving. Identify 3 to 5 quality businesses with durable earnings, strong pricing power, and balance sheets that can absorb a period of elevated costs. Companies that raised prices successfully during the 2022 inflation shock. Companies whose customers keep buying regardless of energy prices. Write them down. Set price alerts, because if this conflict escalates further, if oil pushes toward $100, if the stagflation narrative takes hold, if markets sell off another 10 to 15%, you'll have a list that turns fear into direction. The investors who walked into the 2020 pandemic crash with a written watch list bought extraordinary businesses at prices that never came back. They weren't lucky or braver than anyone else. They were simply prepared when others were frozen. Your future self is watching every financial decision you make in a week like this one. Make the choice they'll be grateful for, like this video. Come back to it as this situation develops, because the inflation ceiling framework I described today applies to every stage of what unfolds next. Whether this conflict lasts 4 weeks or 4 months, the oil inflation Fed chain reaction moves on the same logic I've just given you. Subscribe to Warren Buffett University. We cover the thinking that actually protects and builds wealth. Iran war investment strategy, oil shock portfolio protection, stagflation investing 2026, Federal Reserve rate decision impact, how inflation destroys savings, smart money rotation tactics, energy sector ETF strategy, what rising bond yields mean for investors, how retail investors lose money in a crisis, Strait of Hormuz economic impact, war inflation history, how to invest when markets fall, Roth IRA strategy during inflation, UK ISA investing during geopolitical crisis, and what to do with your money when the world feels uncertain. The worst financial decisions in history weren't made by people who didn't care. They were made in moments of confusion by people who had money but no framework. You just got the framework. You don't need permission to think clearly when the world is panicking. You just need to start.